Hi everybody, it is my pleasure to welcome you all participants from around the world. For those of you who are not familiar with me, my name is Mati Alon and I'm value investing consultant at eToro. This is actually eToro very first education webinar academy where you can obtain top insights from the world's most successful investor and financial leader. We're very fortunate today to have a special guest by the name Robert Hagstrom, noted author and investment strategist and portfolio manager. Robert is the author of numerous books on investing, including the very famous New York Times bestseller, The Warren Buffett Way. Robert currently acts as a senior portfolio manager at Equity Compass, the position he held since 2014. Prior to joining Equity Compass, Robert was a chief investment officer and portfolio manager for 14 years at Legg Mason Management, where he oversees over $7 billion in assets. Most recently, last week, in fact, Robert published his 10th book, Warren Buffett Inside the Ultimate Mind, which now available for a popular investor on eToro Champion and above, who can get Robert's book subsidized. The book is available on Amazon for everybody as well. Robert, it's a real honor for me to have you as our first guest.
Well, the honor's mine, Matty, and it's great to be with you.
So first I would like to start by congratulating you on your new book, which I already had the chance to read it. And why don't you share with us some feedback you received so far?
Well, it was a very humbling book. I've written about Warren Buffett. If we go back to the very first edition of the Warren Buffett Way, it was written in 1994. So for 25 years, I've been writing, studying about Warren Buffett. And I'm somewhat humbled that it took me this long to figure out that I had underemphasized or maybe discounted what was the most important part of the Warren Buffett Way. And that was the mental side, what Ben Graham called temperament, what Warren Buffett then in 2017 at the annual meeting called the importance of having a money mind. And Matty, I tell you, I spent so much time, as we all do, on methods, mechanics. We think if we understand all the methods, the mechanics, how to swing the bat, that's all that's needed. If we do that, we can imitate the great investors. But I came to the final conclusion that what was missing for a lot of people that apply the Warren Buffett methodology, because if you don't have the right temperament, it's a challenge. So this book, which I'm so proud of, really underscores how important it is to have a money mind, the proper temperament that is connected then to the methods. Both of those in tandem then make you a much better investor.
That's interesting. One of the things I really liked about the book, and I'm taking some quote from there, that you mentioned that Warren said that you don't really need a very high IQ in order to be a very successful investor. And it's like, the money mind, it's all about it, right? It's not like investing is a rocket science, but it's more of an art if we take Warren Buffett quote. And can you elaborate on that? Why you don't need to be that smart in order to succeed, and how money mind, connect to that?
Yeah, that's a very, it's a very famous quote, Matty, as you well know. And his point is that what you need, if you think about the methods, and even the methods that we outlined in the Warren Buffett Way, that's something that, a student in college would be able to master by the time they graduated, if not sooner. The dividend discount model, how to read an income statement, things of that nature, return on capital. Those are relatively, I don't want to say elementary, but relatively easy, to comprehend and understand. And what Warren is pointing out is that we continue to sharpen the pencil, try to figure out the methods more, the mechanics more. And my point in the book is, adding more math is not the answer to this. We've already got the basic methodology down of how to understand a stock as a business and value the business. We've got that plainly laid out. That's there for us. The part that we don't have laid out for us is that you have to connect it to the right temperament, the right money mind. And Warren said at the annual meeting, he says he's known people that have had tremendously high IQs in different professions, medicine, law, you name it. But we're terrible investors. They just didn't have the proper money mind, the proper temperament to be successful investing. So it's not an IQ problem for most people. It is a temperament, money mind problem.
And I would just extend on that, and I don't know if you would agree with me, but it's also, you don't have to learn and study or graduate economic MBA or finance to be a good investor. I mean, I personally have friends that came from technology world and just read books and became a very good and famous even investor. What do you think about it?
Oh, I think that's absolutely 100% correct. Myself, I was a liberal arts major in college. I studied politics and did my undergraduate and graduate degree in politics, and kind of fell into investing, through the back door as an opportunity. So I was not schooled on modern portfolio theory and modern finance and things of that nature. What made Warren Buffett so attractive to me is that he didn't emphasize all of that modern portfolio theory mechanics. And we talk about in the book, that's one method, that's one approach. But to be successful in a Warren Buffett way, you don't have to understand any of that. You just have to understand, that you own a business, and we lay out in the Warren Buffett Way the tenets that go with a good business. And then inside the ultimate money mind is the companion piece, which is the mental construct. So you're exactly right. And Warren is actually, you might appreciate this, Matty. Warren actually said, to be a successful investor, you might be better off not mastering all of the modern finance, modern portfolio theory mechanics. You should just be a very simple business owner and reduce it to that part, and then you'll do very well. So you're exactly right, Matty.
Yeah, I agree. Also, the famous Tom Gaynor, which wrote the preface for your book, came from the accounting world and not from finance or economics or things like that. So it gives him a very good access to understand and learn the language of accounting when he's doing analysis. So this is another way of succeeding in the stock market, not just through what everybody thinks. So that's interesting. Over the past few years, we have witnessed growth companies heavily outpacing the so-called value companies. And we see many headlines claiming that value investing approach is dead. I can't think of any better person to ask this question, but is value investing dead?
Absolutely not. I think the way in which some people frame value investing, it may be over. And we talk about that. You and I discussed Chapter 3, the evolution of value investing, and we go through the different, phase 1, phase 2, phase 3 value investing. Value investing is alive and well. I'm a value investor. Warren is a value investor. Guys like Bill Miller are a value investor. We talk about Bill in the book. And we have done extremely well over the last 10 years. It's just that value migrates. It doesn't hibernate. It migrates, and you as a great value investor need to understand where value moves in the market and be able to take advantage of it. And that's the secret. I'm always flustered when someone says to me that they're a value investor, and as soon as value investing comes back, they're going to do really well in the market. Well, that to me is a signal that they have a very narrow viewpoint of where value exists. Sometimes value is in slower growing, low price earnings, multiple stocks like classic value stocks. Other times value can be in high multiple stocks, rapidly growing, network economic businesses, enterprise software. That's where the value is. And Bill was able to teach me that. I worked with him for so many years at Lake Mason. Warren, basically by buying Apple, bridged phase 2 value investing, which was the Coca-Cola world, into phase 3, which is network economics, and just hit it out of the ballpark with investing in Apple. So Warren is the perfect example of a pragmatic value investor who was able to evolve from classic Ben Graham to buying better businesses in phase 2, which is the Coca-Cola story, now into phase 3, which is technology and network economics. It's a great story.
So basically, as I told you when we discussed before, Chapter 3, which is the evolution of value investing, was really caught my eyes. And I think it's a discussion that's taking place in recent years, especially because of the technology, missing out the investment and everything. And also Warren said, I missed investing in Google. And My question for you, and probably our viewer really want to understand that. I mean, from value investor, how do you value a company such those company? I know you're holding Amazon, if I am not mistaken, in your investment portfolio. And how do you even get to this? And I guess this is the third stage. So I'll be happy if you can split the answer from first explain the third stage and second explain how you even going from the value investing perspective to evaluating such companies.
Well, in that chapter 3 is the analogy to how to move from phase 2 to phase 3. We used Bill Miller as our example, and Bill. When I worked with Bill for 14 years, he ran the very famous Value Trust Mutual Fund, which was the only mutual fund to ever outperform the S&P 500 for 15 years in a row. And you had to be a very good technology value investor. And Bill says, we can analyze technology as a business. There's no reason why we can't. And the work that we did at Santa Fe Institute and studying with other scientists out there about complexity economics, and then more importantly, Brian Arthur, who introduced network economics in the study of network effects, helped us understand early in the 1990s how to invest in Dell Computer, how to invest in AOL, and we were in the IPO of Amazon. Bill still owns Amazon. He's got the original shares in his portfolio. We were the largest subscriber to the Google IPO. And then we've moved forward ever since then. So the trick was basically how to think about technology as a business. And there are business signals that you can see in technology companies, largely network effects, lock-in, path dependence, positive feedback loops. These are all business signals that help you understand the moat of a technology business. And we were able to get our hands around that. And so there are additional business insights. Now, what's fascinating, Maddie, is this. And we walked through them. Michael Mauboussin, another great thinker, is an adjunct professor at Columbia Business School, himself a writer. He worked with us at Legg Mason. He's now at Counterpoint Global at Morgan Stanley. He talks about the intrinsic value of high return on capital, right? So a company has a 15% return on capital and another one has 100% return on capital. They both have the same multiples, they both have the same sales growth rate. Which one is more valuable? Well, obviously the one that has 100% return on capital. And what was so fascinating about phase 3 investing is it introduced business models that had low capital needs, that were able to have network effects and grow so rapidly without the need to have a lot of capital. Dell Computer was the first company that did 200% return on invested capital. Amazon was the second one. And when you look at these businesses today, many of these businesses are triple-digit return on invested capital. And that makes them very, very valuable businesses.
But if we take, for example, as you mentioned, let's take Amazon, or even Netflix, they are companies that actually evolved, right? Because in the beginning, Amazon was selling only books, but then it became a company that sells everything. Netflix were shipping out discs to your home and then became a streaming company. So when you're investing in such an early stage in those companies, obviously you don't really know what the future is going to bring. And then if you look at those companies and the evolution of those companies, so there is sort of a risk that you don't have the so-called margin of safety as you had in stage number 1 and stage number 2, when you rely more on the assets because you have pure intangibles assets in those companies. So how you protect yourself, because it's like more reliant on projecting the future, but some of them doesn't even have any real free cash flow because they invest in the future. So how you do it?
Well, it's a multi-level question, and I'm reminded of Tom. You mentioned Tom Gaynor, a great investor at Markel, and has done extremely well. He basically said when we moved from phase 1 value investing to Ben Graham, it was like taking a snapshot with a camera. You froze it in time, and you could look at the finances and say, okay, that statistically looks cheap. And then Tom Gaynor said in phase 2, it's more like watching a movie. You have a movie, you're watching a company, and you have in your mind a script of what you think is going to happen. And that occurs because you're listening to management, you're you're reading the annual reports, and a movie is unfolding before you. Now, if you've got the right movie, or you have the right ending to your movie, and you've done the work, you can make a lot of money. So, but your point is correct. If the movie turns out differently than what you thought, you may have some difficulty. So therefore, margin of safety in your original purchase price is critical. No matter phase 1, phase 2, phase 3 value investing, margin of safety is imperative. You have to have it in every one of your purchases. So if the movie turns out differently in phase 3, you haven't overpaid. So there's some stocks out there that are 150 times sales earnings. And if the movie doesn't turn out like you think it is, you don't have a margin of safety. Today, Google is trading at, 22 times next year's earnings. If the movie doesn't turn out like you think it's going to turn out, your downside is much less. And Amazon is a fascinating story. We talk about it in the book. Everybody misdescribed Amazon. When Amazon came public, they thought, well, this is Barnes & Noble. And, they sell books. They look at the economics of Barnes & Noble, the price earnings multiple, price to book, and they said, oh, Amazon is massively overpriced. You should buy Barnes & Noble and sell Amazon. Well, that didn't work out very well. And then they started, kitchenware and clothes and, TVs, and, it's Walmart. So they said, well, what you should do, Walmart's much cheaper than Amazon. And you should basically sell short Amazon and buy Walmart. Well, that was a terrible trade, too. But the problem was, Bill understood early, we understood early, Amazon was not Barnes & Noble. Amazon was not Walmart. Amazon was Dell Computer. They had the wrong business model description. They had the wrong movie of what was going on. Amazon was Dell Computer in the early stages, the direct distributor of books, then a direct distributor of everything else that it sells today, and it had low capital needs. It was a negative working capital business where you could grow the business off the accounts receivables of your customers. You'd get the credit card that night, selling them a book or a television set. You wouldn't have to pay for it for 30, 60 days. And so there was low capital intensity in these businesses, which made the returns on capital of these, triple digits. So once you figured that out, once you had the movie right and you understood how the movie was going to play out, you had it, you could make a lot of money. And I still think people struggle with what is the movie for Amazon going forward? What is the movie of the enterprise software businesses going forward? And that's where the excess returns is. And I'll say this last point and turn it back to you, Maddie. Charlie Munger said in the annual meeting a few years ago, he said, the time now which you can just run a Geiger counter over a stock and see low price earnings multiple or low price to book and think that you have a home run, that's over. That game is totally over. You have to get into the guts of the business, understand the fundamentals, and then if you get the movie right, that's where a lot of money is going to be made.
It reminds me what he said, the fish where the fish are, right? I mean, it's not easy like they did a fish in the barrel. So I guess my question here, how you implement margin of safety for such an investment? Because again, I mean, if you try to predict how the movie is going to look like, and when we talk about movie, it can be 5 years, 10 years, and even 20 years time in Warren thinking, not everybody really have the capability. So how you suggest to implement here sort of margin of safety? That's the first point. And the second point, are you as an investor tracking your investment for quarter to quarter to see if the movie is going the way you like or it's not going the way you like, or you track it once a year? How do you think about those stuffs?
Well, two good. That's a great. Two very good, great questions there. First of all, yes, we do follow our companies, but we don't pay a lot of attention to price. I mean, price is not value. Price is just market expectations. We're following our companies quarterly, every quarter on their quarterly reports. We follow them every year on the annual reports, anything and everything that we can read about our companies, but we're reading business information. We're reading business fundamentals. We don't think about the stock market too much. We don't think about pricing too much unless price gets so crazy that then there's a flood of opportunities that gets your attention. I think one of the big misnomers is that Warren Buffett is such a celebrity in the stock market, they think that he's absorbed by the stock market. Nothing could be further from the truth. Warren does not pay attention to the stock market much at all. He's very disconnected from it. It's a purposefulness not to be absorbed by the stock market. He's absorbed by his businesses. He's absorbed by the stocks that he owns that are businesses in his mind. So when we do the margin of safety, the way, and we talk about this in the Warren Buffett way, is that there's no one number that's the right number for business value. It really is a cone of probabilities, and we call it the central tendency of value. So you have an optimistic outlook, you have maybe an above average outlook, you have an average outlook, you have a below average outlook, and you have a disaster outlook, right? And it's a cone. And then what Warren teaches us is that you assign probabilities to each of those outcomes. So you assign a probability to each of those movies that would occur. And then you simply take the weighted average of the probabilities of the different movies, and that's your central tendency of value. And then if the stock price is below that central tendency of value, then it's safe for you to proceed. So we do take the worst case scenario, we assign a probability to that, a below average scenario, average, above average, and then, hit the moon. And that probability of hitting the moon is not 100%, but it may be 10% or 20%, like Amazon. And so you have a collection of estimates weighted by the probabilities, and that gets you central tendency of value. I think that's the smartest way to go about it.
So it's sort of like a sensitive table that you play around, or as Warren said once, investing is an art and not, exact science. So you never have like a real one number valuation for a company. That's really interesting. If we spoke already about Bill Miller, and I really like Bill Miller and tracked his investment over the years, which I totally agree with you. I mean, Bill Miller said once that he finds value investing in any assets he invests. It's all matter of, price you pay versus what you get. But usually it's what you get from the cash flow the business is producing, right, over the life of the investment. But in 2017, Bill invested a massive amount of 50% from his AUM in his new hedge fund in Bitcoin. Now, we all know what's Charlie and Warren thinking about the Bitcoin. Can you share with us, from knowing Bill, what his thought on this? Is he maybe evolving to stage number 4 that you didn't even read about?
That's interesting, Matty. Well, I would say this about Bill and Bitcoin. He obviously was right when a lot of other people were wrong. And so there's some that are still skeptical about it, but there's no doubt about when Bill made this bet on Bitcoin, and this goes back many, 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 many years ago, start date. This wasn't just last year or 2 years ago. He has Bitcoin, at very cheap prices. Now, he didn't put Bitcoin in his big mutual fund, the Opportunity Trust. Which is there. He did run private money. He did have a hedge fund money. He never invested initially 50% of his personal net worth or 50% of his hedge fund money on the first bet. But it did become a very large part of the holding because of the massive capital appreciation. So you're right about that, but it wasn't. I don't know anybody that would bet half their net worth on any one thing today. Not even Warren, not even myself, not even Bill.
Right.
So it was an investment that paid off. But what is fascinating about Bill, and Bill has done more for me to move me from the theoretical methodology to the practical, getting to the practical side. Because I'd always argued that I thought Warren was a growth investor. He just understood the value in growth companies. And so when I went to work with Bill, he ran the Big Value Trust and I ran the Growth Trust. And so I was applying the Warren Buffett methodology to growth companies, global growth companies, when I worked with him, and it worked out swimmingly well. Same thing that I'm doing today. But Bill is a pragmatist, and pragmatism is the secret to long-lasting success. Now, Warren talks about rationality, and in Chapter 2, we talked about the philosophy of investing and how Warren moved from self-reliance to, Stoicism by Ben Graham. We get into the philosophy of Stoicism, how important that is, and that's part of the money mind. Self-reliance is part of the money mind. Stoicism is part of the money mind. We go into Charlie Munger's multidisciplinary thinking. We wrote a book called Investing the Last Liberal Art, which goes into multidisciplinary thinking. How does that aid you? The psychology of misjudgment. And then we go into rationality. Rationality is what makes you successful today. A rational person will use the best methods, the best approach to investing to optimize their returns. If you're rational, you will seek out the best methods to optimize your returns, okay? That works today. But the pragmatist is what makes you successful over time. Rationality makes you successful today. Pragmatism makes you successful over time. And the great investors, Warren Buffett and certainly Bill Miller, who went from phase 1 to phase 2 to phase 3, just as Warren has gone phase 1, phase 2, phase, are pragmatic. They followed where value is and were able to exploit it. Most investors that are successful and have been successful at investing for a period of time, acquire what's called a correspondence theory of truth. They believe that they figured out what is the deep embedded truths of investing, and they just replicate that over and over and over. But markets evolve, companies evolve, models evolve, and if you're anchored to a correspondence theory of truth that this is the way markets act and they will always act that way, you're going to miss out on one of the greatest growth stories, of our generation, which is global network economic businesses. And if you had a correspondence theory of truth that you would only buy low price earnings multiple stocks, and you would wait until value investing came back to that, you missed out on a lot of wealth. So pragmatists make you successful for tomorrow. Rationalists make you successful today.
So that's interesting. So what I'm trying to understand, I understand that, stop going only and chasing only for the low PE because this is value investing and all these things. And it doesn't necessarily mean that. As you said, even in 86 or 88, I think Warren paid, what was it, like 15 times earnings for Coca-Cola and 5 times book. So it has nothing to do with value investing, as Ben Graham wrote it. But today, I think in the past maybe 3 years or even 4 years, we hear the word, price to sell. And price to sell, it's an amazing, but if you don't have a bottom line, what we call in investing, so you don't have the net profit, you don't have the even free cash flow, even after we do adjustment, is that the pure growth we're talking about? Yeah, I mean, as value, although we want to invest in the future and count on the future, are we still need to see some real free cash flow coming in?
I think that's largely right, Maddie, and I think you've got your hands around it really well. If you understand network economics, and we go through this in the book in phase 3, you understand the life cycle of a technology company. You can kind of figure out how this thing evolves over time. And so it may be cash poor in the beginning because it's reinvesting all its money back into the business to make it grow, and it's not reporting to the bottom line a lot of cash, but you can actually see how this thing is evolving. And if you've got that movie right, or you got that evolutionary part right, you'll do pretty well. Now, having said that, Amazon, if you look at Amazon today, and you can go to Morningstar, you go to any analyst, right, and you look at Amazon today, and everybody says, it's 45 times earnings, 50 times earnings, whatever. If you go through it, and you've got total revenues, you take all out the expenses of it, and you get down to what would be called very simplistic operating cash flow. Just basically, how much cash did I make? Then you have a couple of decisions. I can drop it to the bottom line. I can pay it in dividends. I can buy back stock, or I can throw it back into the business that's growing at a double-digit rate, earning 100% return on capital. So Jeff Bezos had these decisions. What should I do? Well, if your company is growing at 20, 30, 40% per year, earning 100% return on capital in a global marketplace, which is the largest total addressable market, what should I do with my operating cash flow each and every year? The answer is you should put it right back into the business. And so that's how he grew it into a $1 trillion business. It wasn't important for him to drop it to the EPS line so you could tangibly see it, but you could tangibly see it. If you walked up the income statement, you could see where the cash flow is. And as a matter of fact, you can look at it. I think last time I looked at it, the operating free cash flow yield of Amazon was about equal to Procter & Gamble. And so there's a lot of cash gushing out of Amazon, and it's right there. But I saw exactly what he was doing with it, which is putting it back into the business, which is what he's supposed to do. But if you're stuck in phase 1 value investing, you're saying, well, it's not a low PE multiple stock, so it must not be a value proposition. Well, undoubtedly, Amazon was the most valuable mispriced business over the last 10 years. I think it's up 3,000%. It's just amazing. So you have to think about it from a business person standpoint. What would a business person do with the money? And not every business person would put it all in the bottom line. They'd reinvest it back into the company.
Yeah, I agree with you. I mean, it's so-called the capital allocation of the CEO, in the business, how we deal with that capital. And usually maybe it's good to point out to our audience here is that when company mature usually and they don't have how to, grow fast, so they have money left and they can do with that maybe two things, either give it to us as a dividend or do a buyback. But as long as the company can accelerate growth and so it has nothing bad with that, I would just point out that every $1 you keep putting to investment as invested capital, it's important to see that the return on invested capital is not going down. So then you see that the growth is real there. That's something is really important.
And I'll share with you one additional thing and interrupt you. You're exactly right, Matty, which is if you let a company keep your earnings each year and put it back into the business, you're definitely keeping an eye on the trend line of return on invested capital. You want to make sure it's at least stabilizing and it's not declining, right? But the second thing you can look at, which Warren Buffett talks about, and we talk about it in the book, which is for every dollar invested, are you creating at least $1 of market value, if not more, right? So if you're earning above the cost of capital and you're investing $1 back into the business, you should be getting at least $1, if not more. But when you look at some of these investments, the amount of money that Bezos has retained over the years, the market
amazing, but if you don't have a bottom line, what we call in investing, so you don't have the net profit, you don't have the even free cash flow, even after we do adjustment, is that the pure growth we're talking about? Yeah, I mean, as value, although we want to invest in the future and count on the future, are we still need to see some real free cash flow coming in?
I think that's largely right, Matty, and I think you've got your hands around it really well. If you understand network economics, and we go through this in the book in phase 3, you understand the life cycle of a technology company. You can kind of figure out how this thing evolves over time. And so it may be cash poor in the beginning because it's reinvesting all its money back into the business to make it grow, and it's not reporting to the bottom line a lot of cash, but you can actually see how this thing is evolving. And if you've got that movie right, or you got that evolutionary part right, you'll do pretty well. Now, having said that, Amazon, if you look at Amazon today, and you can go to Morningstar, you go to any analyst, right, and you look at Amazon today, and everybody says, it's 45 times earnings, 50 times earnings, whatever. If you go through it, and you've got total revenues, you take all out the expenses of it, and you get down to what would be called very simplistic operating cash flow. Just basically, how much cash did I make? Then you have have a couple of decisions. I can drop it to the bottom line. I can pay it in dividends. I can buy back stock, or I can throw it back into the business that's growing at a double-digit rate, earning 100% return on capital. So Jeff Bezos had these decisions. What should I do? Well, if your company is growing at 20, 30, 40% per year, earning 100% return on capital in a global marketplace, which is the largest total addressable market, what should I do with my operating cash flow each and every year? The answer is you should put it right back into the business. And so that's how he grew it into a $1 trillion business. It wasn't important for him to drop it to the EPS line so you could tangibly see it. But you could tangibly see it. If you walked up the income statement, you could see where the cash flow is. And as a matter of fact, you can look at it. I think last time I looked at it, the operating free cash flow yield of Amazon was about equal to Procter & Gamble. And so there's a lot of cash gushing out of Amazon, and it's right there. But I saw exactly what he was doing with it, which is putting it back into the business, which is what he's supposed to do. But if you're stuck in phase 1 value investing, you're saying, well, it's not a low PE multiple stock, so it must not be a value proposition. Well, undoubtedly, Amazon was the most valuable mispriced business over the last 10 years. I think it's up 3,000%. It's just amazing. So you have to think about it from a business person standpoint. What would a business person do with the money? And not every business person would put it all in the bottom line. They'd reinvest it back into the company.
Yeah, I agree with you. I mean, it's so-called the capital allocation of the CEO, in the business, how we deal with that capital. And usually maybe it's good to point out to our audience here is that when company mature usually and they don't have how to, grow fast, so they have money left and they can do with that maybe two things, either give it to us as a dividend or do a buyback. But as long as the company can accelerate growth and so it has nothing bad with that, I would just point out that every $1 you keep putting to investment as invested capital, it's important to see that the return on invested capital is not going down. So then you see that the growth is real there. That's something is really important.
And I'll share with you one of this, didn't interrupt you. You're exactly right, Matty, which is if you let a company keep your earnings each year and put it back into the business, you're definitely keeping an eye on the trend line of return on invested capital. You want to make sure it's at least stabilizing and it's not declining, right? But the second thing you can look at, which Warren Buffett talks about, and we talk about it in the book, which is for every dollar invested, are you creating at least $1 of market value, if not more, right? So if you're earning above the cost of capital and you're investing $1 back into the business, you should be getting at least $1, if not more. But when you look at some of these investments, the amount of money that Bezos has retained over the years, the market value has far outstripped the dollars invested in the business. So it's been absolutely the right thing for him to do over time. So you're exactly right. Good observation.
Yeah. So to summarize this point, I have a question and we can discuss it because I'm still thinking in my mind always Dan Graham is sitting here and saying, you guys talking nonsense, you don't know what's value investing and things like that. But if we look at Warren Buffett's history of success and failure, his failure were either missing buying or buying too late or selling too early. But in recent years, we've seen Warren really putting what he called like the elephant bet, if it was on the Kraft Heinz, if it was on Precision Castparts, and in the stock market, he put also on IBM. And he really, really missed big time here. And what I'm trying to ask you is that maybe that's because he's in chapter 3, that's because he doesn't have enough the margin of safety that he used to demand from price perspective. He rely more today on the future rather than what he pay now. And just before you answer, if I take what you pointed out for Apple, Warren Buffett, actually, it's funny. I looked at Apple when he bought it, and he bought Apple when everybody started saying, Apple is dead, that's it, they cannot sell any more iPhones. And he actually paid, I think it was 12 times earning? It's ridiculous, right, to think about buying Apple at 12 times earning. So there he really took an action for the price. If you would ask me, I think Apple was sort of a deep value when he paid them, and it's amazing, right? So what's your take on that? How should we think about it? Because I think this one of the things that's saying here, this is why value is dead. This is why value is wrongly, in this world. Well,
Warren talks about the mistakes and we all make mistakes. I make mistakes, you make mistakes, Warren Buffett makes, Bill Miller makes mistakes, right? Is that there are two types of mistakes. The mistakes of commission, right, which is, you've just analyzed it badly, and Kraft Heinz, Warren said, I overpaid it. And, I misanalyzed the business. We are not perfect. We'll have error rates in our portfolio. There are other mistakes, though, and Warren talks about them as heirs of omission, which is not taking action. And he talked about, I missed Amazon. He said, I sat on my hands and, I couldn't figure out how, he said, he and Charlie grew up, studying, Rockefeller and Carnegie and Mellon, all these great industrialists, and he couldn't quite piece together how these companies were creating billions of hundreds of billions of dollars in market value with so little capital expenditure. So he was somewhat slow catching up to network economics. And so they're errors of omission. But both Apple is a fascinating story, and you're exactly right, Matty. When he bought it back in 2016, or when Berkshire started to buy it in 2016, it was discounting no growth. If you reverse engineer the valuation, the market was attributing the value of Apple to no growth. They thought, it's a static cell phone. They, thought it was Motorola or Nokia, whatever the case may be.
I agree.
And it was a perfect, as I just said, people misdescribed Amazon as Walmart or Barnes & Noble, and in fact with Dell Computer, they misdescribed Apple. Because as Warren finally figured it out and then made the huge bet on the company, first of all, Apple was not Nokia or Motorola. Apple was Louis Vuitton. So it was I think it sells, 13, 15% of the world's smartphones at the time and was getting 85% of the profits. People were in love with it. And it was a product, as Warren pointed out, that an 85-year-old or a 15-year-old could not do without, and they would continue to buy it. The network effects were working. They were in lock-in now. Nobody wanted to change phones, and they wanted the prestige of owning the Louis Vuitton of Apple phones. So he figured that out. And it was kind of like Apple, same type thing. But then what really kicked it was he finally began to see, as others began to see, what was the value of the services business, the app stores and the online things. And when that kicked in and finally people figured out that's the fastest growing part of Apple, that's the highest return on capital part of Apple, then the market figured it out, and that's where he got his 3 and 4 baggers and 5 baggers. That movie actually turned out as he thought it would, just as Coca-Cola turned out, because of what Roberto Gozzietta, the CEO, was doing with the business of Coca-Cola in the 1980s. He could see this movie unfolding in his mind and knew that if Roberto Gozzietta kept doing what he was going to do, Apple was going to make him a lot of money. He made 10 times money on Coca-Cola in 10 years, and the S&P was up 3 times, and everybody thought he overpaid for Coca-Cola. Well, in Apple, they went, oh, you bought Nokia. Oh, you bought, Motorola. What a dumb idea. Well, in fact, they had it misdescribed. Warren described it correctly. And as the movie unfolded, that's where the largest amount of money was made. So sometimes things are, we have to say, things are right in front of you. They're hiding in plain sight, right there in front of you, but you've misdescribed them. And if you misdescribe them, then you don't have the right explanation. Warren had the right explanation on Coca-Cola, and now it's been proven that he had the right explanation on Apple. And that has a lot to do with the philosophical construct of a money market.
By the way, I think another good thing to point out here is that even after he initially bought the shares, as the movie evolved, if I recall right, after like 6 months or even 7 months, after the shares almost went up, 50%, he then added massive amount to the company. And I think this show our viewers 2 things. First, the fact that something going up 50% after you bought it means nothing from perspective of value investing, because at the end of the day, it means that there is more value, intrinsic value, as Graham used to call it, in the value compared to recent price. And I guess that's what Warren saw, and he jumped on that, and today is the largest holding of Berkshire Hathaway. So that's an interesting part from perspective of valuating and really viewing and thinking about the future, but I really agree with you about it. I have a few questions for, go ahead, I'm sorry.
No, you just pointed out pricing is not value. Just because something goes up, Warren says polling does not replace thinking. Just because something goes up doesn't mean it's not more valuable. And just because something goes down in price doesn't mean it's more cheaper, right? Pricing is just the market's expectations going back and forth. Price has nothing to do with value. Value is the understanding of the economics of the business. And if something goes up 50%, it still could be worth a lot more, and you shouldn't avoid it just because it's gone up 50%. You don't know until you actually get into the guts of the business and figure it out. So it's a very important lesson, Maddie, as you pointed out.
Yeah, no, I agree with you. And I think the best example can be from your book about the Coca-Cola. Warren actually bought Coca-Cola after it compounded at 17% in the previous 5 years before he bought it. So that's a mind-blowing. It's like looking today and say, what, this company is up 200%. I'm not going to buy it. It's too expensive, but it has nothing to do with those things. And he still, did many buggers on that. That's totally amazing. I would like us to move to a little bit more question about a little bit more education from perspective how you can help our audience. And first, I saw in your investment that you hold ETF, and we have ETF, of course, and there is a lot of ETF, and it's sort of diversification. Warren Buffett talked about ETF as a good alternative to investor, passive versus active. Can you share with us your point of view about ETF, how you use ETF, and why you use ETF?
Well, we do have in our business, Equity Compass Investment Management, we have several strategies. I run a global growth strategy. It's all individual stocks, no ETFs. But we have other strategies that in fact do use ETFs, and they're very valuable for us, particularly in the fixed income market. That we will use ETFs to build out a fixed income portfolio of different durations and things like that. So in many ways, active ETF investing is very cost-effective, very sensible approach, and you can put together a very sensible portfolio using ETFs. And it's not, I would say to this, if you want to be a buy and hold investor and you're not going to trade your ETFs, you're not going to buy and sell ETFs, you should own a broad basket. You know, you should own like the Wilshire 5000. You know, if you just want to buy a call option on global growth and you're not going to sell anything for 5 or 10 years, then you want the most broadest diversification that you possibly can. If, though, that you are going to be an active investor that uses ETFs, then ETFs can be very valuable for you as you can perceive where mispricing is in the market, whether it's fixed income or even in the equity side. And I've seen smart investors layer on an ETF if they want to increase their weight in energy without disrupting their portfolio largely. Maybe they want to add more energy or add more financial companies without doing a lot of capital gain selling or whatever the case may be in the portfolio. They believe that's a cheap part of the market. You can actively add an ETF in sectors that can give you the octane in your portfolio to help you, generate better returns. So ETFs have a role, but it's how you use them, right? If you use them thoughtfully because you perceive mispricing, they're very valuable. If you use them to speculate, which is, I think people are going to be buying energy stocks, so I'm going to buy an energy ETF, and you're making a decision based upon what you perceive other people are going to be doing in the next 3 to 6 months. Well, that's largely speculation. That doesn't have much to do with investing.
Yeah, and it's interesting you said it, because I think it's really, really important to point out that the idea of buying ETFs, and I think I will also mention this, Buffett said many times that if you don't know how to do investing, so you better go with ETF. And Warren's idea was that when you buy an ETF, buy it for the very long term. Don't buy it to, as you said, speculate. Don't buy it and the ETF is going up 20%. That's it. You sell it, because when a person buying an ETF, let's take an example, the largest ETF, which is the S&P 500, you literally, as Warren Buffett saying, betting on America, right? So if you bet on America, you don't bet on America to go up 20%. You bet on America to continue growing for many, many years to come. So just to take your point, it's very important to, keep saying that don't speculate, don't play ETF, just like you don't play stocks, a particular instrument. ETF is not for that. It's more for really viewing the strategy. Yeah, you can take advantage, for example, if it's an industry in the ETF because it collapsed like many did, I don't know, in the oil market or the housing market, and then to enjoy this increase in diversified way. But the idea is that if you want to be a passive investor, so you should go, buy and hold for many, many years. So that's, I think it's important to point that out. Let's talk a little bit about volatility. One of the things that everybody's scared of, everybody cannot take, waking up in the morning, seeing the market are going down, and then after an hour it's up. Some people I'm seeing sometimes, whoa, the pre-market, the market is about to start minus 2%. The market open after 15 minutes and it's like at zero. This caused lots of movement, and especially in last year when we saw the pandemic hitting. Can you talk a little bit about volatility from your perspective, how you can give some advice to our viewers to deal with that, to not be, affected by that? Because we all know that if you are exposed to the market volatility, you are the main risk for yourself, because you're going to start doing some action from your, guts and not from really head. So can you help us?
Yeah, Matty, that's a great question, and it's so very important because it's so timely. Obviously, certainly within the last year with the pandemic and everything like that, volatility it really is all over the map, and some of that has to do with structure of markets. The number of different strategies that are involved today, and we point out in the book, I think, that you have to realize that there are multiple strategies going on in the market at the same time. We have a tendency to think about when we buy a stock, we're in the market. And if the market is going up, you think, oh, everybody agrees with me. I make the right decision. Or if the stock market goes down or your stock goes down, you go, oh, gosh, I must be wrong because everybody disagrees with me. You have a tendency as an investor to think about whether you're being right or wrong is whether the stock price goes up and down. But as we talk about, in the book, is that there are tons of different strategies going on in the market simultaneously all the time that have nothing to do with value-based approaches. There's program trading, there's speculation, there's macro trading, there's tons of money in hedging portfolios. Option value today is greater than stock volume today, and arbitraging the difference between option price and stock prices. So prices are moving around all over the market for reasons that have nothing to do with the value of your business, but have everything to do about the gaming of future stock prices. Okay, that's a different game than what we're playing in the Warren Buffett way. We're a business value investor. But having said that, Maddie, and that's why this question is so important, I'm very empathetic for individual investors who want to be business investors, but are disheveled. It's emotionally gut-wrenching to see these prices move around all the time like that. So we wrote in the book the chapter on business-driven investing. The way to think about it is, I don't know if your viewers, I'm probably dating myself, remember the old Twilight Zone series with Rod Serling, but it was called the Twilight Zone, and he talked about, the fifth dimension. So I said, well, you got to treat investing almost like, the Twilight Zone. So let's have two dimensions. We have the market zone, which is where everybody is behaving today. They're looking at the stock prices, they're watching financial news networks, they're seeing the red and the green and the price and up and down. Well, that's the market zone. Then there's something called the investment zone. And that's the fifth dimension. You're going over to a new zone. That's where Warren Buffett lives, right? That's where business analysts live. That's where, Berkshirists live. They live in the investment zone. And it's a purposeful detachment from the stock market. You own businesses. You don't own stock prices. Quit thinking about what you own as a stock price. If you can get that out of your mind, that you don't own stock prices, you own businesses. The business investor lives in the investment zone. And if you live in the investment zone, it's a purposeful detachment from the mosh pit that's the stock market. You don't even think about it.
Right.
I see it. It was up, it was down, it's doing that and another. But then most people live in the market zone. They're so absorbed by everything that is moving in the market, red and green, up and down, volatility, that they forget about what they actually own. And if you live in the market zone, that's where all the mistakes are made, because it's so easy to make all the psychological, emotional mistakes that are made following market prices in the market zone. But if you detach and go live in the investment zone, it's a wonderful world. It's great. You own a business, you study the business, and you look at the stock market, and sometimes it's going in your direction, sometimes it's not. But very rarely do you ever think you're right or wrong because what's happening in the market in the short run. You've got to make that distinction, and we point that out in the book.
Yeah, no, I agree with you, and I mean it's always good to remind people that when you're buying shares in a company, there is a real operation behind it, from revenue all the way to the bottom line, kick and running, and it's not like something happening in one day or 2 days, and over time, if the management will do the right thing and the product is good, so hopefully, the market will also take the shares in the same way that the business will go. And I guess if I'm, mirroring what you're saying, that's the most important thing to watch, the business and not what the share are doing, unless there is, crazy movements. In regards to, one of the main questions, but this particular question I get is the zero interest rate, money printing, inflation. Those are the 3 points I'm getting from many people, which are, they don't really know how to eat it because we never had such a zero interest rate. Inflation, I think a lot of today generation, investor generation, the young one, never, witnessed a hyperinflation. And they just don't know how to act in that. And you see people really trying to understand where are we going next. And, people understand one thing, that printing money, it will be costly today, tomorrow, or in 3 years. And I'll be happy if you can help on this side of your thoughts, how you guys look at it, because you're probably getting it from your investor as well. So,
well, yeah, Matty, I know this is the topic du jour. I think right now the short-term move in stock prices seems to be held hostage to changing in interest rates and changing inflation expectations. Let me just say, I am not an economist. I'm a business analyst. I'm not a market analyst. I'm a business analyst, and so I am not in my my circle of competence here. This is an area, but I would point out this: the market has, for the last 30 years, had a step-down function in interest rates and inflation, largely because our society is changing. As we're getting older demographically, we have more older investors, not younger investors. Therefore, the younger people are the ones that are spending more, saving less, and that fueled a lot of economic growth in the 80s and 90s. As you get older, we're saving more, spending less, so the economy begins to slow. In addition to that, technology is a huge deflationary force, which caps off the rise in prices. We don't see any rise in prices in wage growth much anymore. In the 80s, 70s, and 80s, you used to see that you do contracts with employees, it had an inflation rider in it. You don't see that anymore. Global supply chains were a huge dampening effect on inflation. So there's certain structural effects that have occurred over the last 20 and 30 years that have dampened not only the rate of economic growth, but inflation, and along with that, interest rates. Now, most recently, we've had a change in complexion, and it may be that when we got to 50 basis points on the 10-year last August, that was too low. Remember, before the pandemic, we were going at 2% GDP, and we had 3% 10-year rates, and the market didn't care about that at all. What the market is a little upset is the speed and magnitude of which we've gone from 50 basis points up to 175 basis points in a very quick period. I mean, you talk about volatility in the stock market. Ask a fixed income trader how they think about volatility. It's a totally different world. If the stock market had the volatility of the bond market right now, people would be losing their minds because we'd be up, 2,000 points each and every day and down 2,000 points. That's how much the bond market is. But I think what's happening, and I'm very reliant on a great fixed income strategist that we have at Equity Compass, Jim DeMasi, whose thesis, and I believe it's correct, is that this is more of a cyclical phenomenon. Anytime you get an economy that recovers out of a recession, you get a reflation trade. Inflation does move up. When we recovered out of the 2008-2009 financial crisis, we got to 2010, 2011, the economy is recovering. We printed 4% year-over-year inflation. And then inflation dribbled back down to 2%. So, yeah, inflation is going to go up. And I wouldn't be surprised to see, 4% year-over-year change in inflation prices. I wouldn't be surprised if the interest rates on the 10-year go above 2%, 2.5%. That wouldn't bother me at all. Now, it will have a short-term effect on stock prices, but for my business valuation, not a big deal at all. Not a big deal at all. So, last thing, this is all cyclical, short-term phenomena. It's not systemic, secular. Even the global supply chain, which is in a mess right now for many different reasons, and then 2 days ago, metaphorically, you've got a ship stuck in the Suez Canal that's disrupting the global supply chain. That's frictional costs that'll go away over time. That's not systemic secular. So my view is that the next 10 years will be more like the last 10 years, which is kind of 2% real GDP in the United States, 2% inflation, which gets you kind of 4% nominal, with long-term interest rates, 2-3%, maybe 3.5%. In that world, you can make a lot of money as a business analyst.
So that brings us again to your point of, especially from value investing perspective, that know your business. if your business is good, it can witness, a higher inflation rate, lower inflation rate, in different environments, because at the end of the day, you buy a business and then you don't buy what's the macroeconomics. If we take backwards for a few years, so people said that the fight with China is going to kill the economy, and it didn't kill the economy. And there are so many reasons all the time to find the excuse why to run out of the market or create the volatility. But I think it's a good point to remind again that when you're buying something, you need to buy it for the long term. You cannot really rely on what's happening in the short term. And yeah, maybe we'll have a higher inflation, maybe we'll have a lower inflation, but I guess just to mark down your point, this is not how you base your investment on. You base your investment on the intrinsic value of the particular company you invested in.
Matty, I would say, one point to you, the risk is all about your time horizon. If you said to me, what is the risk of owning Amazon or Apple or Google for the next 10 years at these prices? I'd say relatively low. We'll be worth a lot more in the next 5 to 10 years. If you said to me, what is the risk of owning Amazon, Google, or any of those tech stocks over the next 5 months, I would say, well, it's very high. I have no idea whether it would be high or low. But so an investor is looking to own something over a multi-year period of time. A speculator trader is interested in quick money and is making trades over months. Now, that's a harder game. Our game is easier, although psychologically more challenging, therefore the need to have a money mind. But investing is actually a very easy game to play if you set it up properly. And you said the great Charlie Munger quote. He says, I only have to ask 2 questions of someone. What do you own and why do you own it? So it goes back to know what you own and know why you own it. And if you answer those questions honestly and rationally, investing is a much easier game.
It's also remind me now that when people ask Charlie, well, you guys missed out the tech, like, Google and Amazon. And he said, we didn't miss out. I mean, we just didn't understand the business, but we did just fine without it. And I think that's the important part here. It's not like you don't have to invest in every place that everybody buying. You can still buy things that you understand and make money over time. So that's just, empowering what you just said. Last question here for me is, one of the quotes I took from your book, and I think it's extremely important because not many books talking about it, and I'm quoting, it's failure misjudgment can be equal beneficially to study success. Can you please elaborate to this on us? Because I think it's such an important thing for investor to understand. Investor always try to understand how good they did. They never try to understand how bad they did.
Yeah. Well, one of the things that Bill Miller taught us many years ago was, as investors, we should keep a daily journal, and it's like a diary, and you write down, because it's interesting, if you write down, when you did something good, and then when you did something bad, and you say, this is why I made a mistake, and this is why I was good, and you keep this daily journal over time, and then you go back and read it from time to time, you're more likely to learn from your mistakes. And that's important because we all are going to make mistakes. Nobody's perfect. Everybody's going to make a mistake. The challenge is, do you then understand how you made that mistake, why you made the mistake? It's what Charlie Munger wrote in his great book, Charlie's Almanac. It's the psychology of misjudgments, right? How do we make bad decisions? The journal helps you figure out when you were right and when you were wrong, and you study your mistakes. And by studying your mistakes, hopefully, you'll prevent making that same mistake twice. Studying success, as we do in the Warren Buffett Way and in the Money Mind, is very important. But equally important is studying, as you said, Matty, your misjudgments, your mistakes, and doing that, you actually become a better investor.
That's exactly right. Robert, it's been a great pleasure having you with us. I hope we had another 3 hours we could speak here, but we will invite you again in the future. Good luck with the book, and I really appreciate you sharing your insight with us and thoughts. And thank you so much. And, keep doing the great work and contribution to the value world.
Well, Matty, thank you so much for the invitation. It was a pleasure to be with you. I wish all your investors and your colleagues the greatest success. Look forward to being with you again sometime.
Thank you. Thank you so much, Robert. Thanks.